Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. One of the golden rules of smart investing is diversification. But almost half of all Australian investors are unlikely or unsure whether to diversify their portfolios. It's an alarming statistic considering all the evidence that shows the importance of not putting all your eggs in one basket. Every year, HSBC Australia surveys local investors for their Investor Insights survey, revealing exactly what they're doing with their money. Remember, this is general information only, and you should always seek professional advice before making investment decisions. David Talbot is Senior Manager Investments at HSBC Australia. David, welcome to Fear and Greed.
Thanks for having me, Sean.
Why are investors shunning diversification? I would have thought that's kind of the first rule of investing.
Yeah, it's interesting. When we've done the survey, we asked investors whether they would consider diversifying their portfolio further in the next 6 months. And what we've seen over the years of doing the survey is a bit of a downward trend. Initially in 2022, we asked respondents that question. 60% said that they would. Last year it was down to 58%, and now this year it's just 51%. So we're seeing a downward trend, certainly in terms of whether the Australian investors looking to diversify further. Now, the interesting thing about our survey is that we started it back in 2022 when Australians were just coming to terms with high interest rates, higher inflation, and the cost of living crisis really hadn't hit its full steam, so to speak. And so what we get to see over the last couple of years is how those factors in the broader economy have affected the Australian investor. And what we can see also in the statistics is that Australians are less engaged with their investments. Last year, 4% of Australians said that they don't check their investments at all. Now that's up to 10% this year. So you're having an investor base that's much less engaged with their investments. I think that flows through, Sean, to the diversification piece. If you're less engaged, you're less likely to consider other options and less likely to diversify your portfolio further.
So when we're talking about diversification in this case, what are we talking about? Is this away from the focus on Australian shares primarily, or is it much more than that?
Predominantly, we have seen Australians focus on onshore assets. 75% of what Australians invest in is in onshore. So there's definitely opportunities for Australians to look overseas. Now, when you do break that down a little bit further, it does seem to be more of a generational split. So the older generation, the baby boomers, 87% of what they invest in is in onshore assets. The youngest generation that we surveyed, Gen Z, 63% of what they do is onshore. So a pretty big difference there in terms of what the older generation is doing versus the younger generation. So I guess more of a tendency there for them to look offshore. And I think looking offshore is definitely an opportunity for clients or investors to think about investing and diversifying further. What we see as well when people are diversifying is you can diversify across sectors as well. We are quite spoiled in Australia when it comes to our market. You know, we have got a great real estate market for investors. And when you look at the stock market as well, dominated by financials and by, mining companies, they pay great dividends. They've got stable earnings as well. And so if someone locally is looking to invest, it's a pretty easy decision to kind of invest in one of those assets. And so we see that in the statistics as well. 36% of what Australians invest in onshore is in financials, which is the largest sector that they invest in onshore. So I think, Sean, it's twofold. It's an opportunity to look offshore. Certainly there's opportunities there, but as well on a sector basis, I think there is a chance to broaden that exposure as well.
The survey says that older investors, and I'd hate to put myself into this category, but it actually spoke to me totally, are more likely to invest in financials and potentially resources. Younger investors are more likely to think about tech stocks and that. Is that, I suppose it's natural because a younger person who has grown up with social media understands technology probably better than they understand Commonwealth Bank. I get that. But is it a good or a bad thing that there's a diversity in ages in terms of the sectors they're going into?
I think it represents an opportunity for each generation to, broaden their exposure further as well. Sean, some more statistics that we saw that come through in the survey. The younger generation was investing actually a lot in crypto and NFTs. So 39% of Gen Z, 36% of millennials in that asset class. And that was the main asset class that actually invested in the last 6 months. On the other end, you had Gen X and Gen Z investing predominantly in fixed income and term deposits. So quite a difference there, I think, in terms of the risk appetite from different generations. I think potentially what it is a reflection of, Sean, is that the younger generations have seen the older generations build a lot of their wealth from real estate in the last sort of 10 to 20 years. And, when average property prices in a place like Sydney is, $1.5 million, it's hard for a young person to figure out a way to get into that market. And so maybe they're taking a little bit more risk and broadening their exposure a little bit more to things like technology, like you mentioned, Sean. Then the older generation might sticking with things that are a bit more comfortable. So it's potentially a reflection of the younger generation trying to bridge that generational wealth divide that seems to be at play in Australia.
Stay with me, David. We'll be back in a minute. My guest today is David Talbot from HSBC Australia. What about investing in ETFs or bonds? So perhaps less sexy products, for want of a better term. You're not jumping on a WiseTech or you're not jumping on an Nvidia or your whatever. You are investing in debt markets and ETFs. Where's that going?
We've actually seen a bit of a trend downwards for Australian investors in the last couple of years in terms of whether they would look at that particular investment. So we asked our respondents, whether they would consider investing in an ETF or a managed fund or a bond in the next 6 months. Originally, 55% of respondents said that they would, 53 last year. Now it's down to 47. Now, look, I think it's an interesting move that people seem to maybe be taking a little bit more, let's say, ownership of their investment strategy and in investing in things that they, perhaps take a specific interest in. That being said, though, I think if you come back to the golden rule of diversification, I think ETFs and managed funds, although not being as sexy as you mentioned as perhaps some of the single stock investments you can look at, are a great way to follow that kind of golden rule of diversification and get broad exposure to markets that maybe investors might not be familiar with as well. If you're looking to kind of dip your toe in overseas, so to speak, as well, if you're predominantly looking at onshore, you've been investing onshore for a while. Something, a single stock overseas, perhaps in the technology sector in the US, might seem a bit intimidating. But if you look for an ETF or a managed fund that gave you broad, diversified exposure, it allows you to enter into the market at a lower level of risk, but then also diversify your portfolio further as well.
What about the idea of timing and time in the market? So another, I'd put this alongside diversification in terms of if you're a long-term investor, you've got to be in the market for a long term, as opposed to trying to get in and out and time the ups and downs. Does the survey say anything about that?
Yeah, we have seen that Australian investors are investing less frequently. So we ask respondents whether they invest regularly. Last year, 20% of respondents said that they invested on a regular basis, and now that number's actually increased to 26% of investors. So I think it does speak to the Australian investors being perhaps a little bit more fatigued, if you will, or shifting their priorities. And again, we spoke about the impact of cost of living crisis and higher inflation that's been playing out, and perhaps that's a part of the reason why Australians aren't investing as regularly. But I do agree, Sean. I think that investing regularly is another golden rule, because if you're trying to time the market, I think two risks really come to life. One, it's very, very difficult. Particularly if you're a retail investor, so to speak, you're up against some big players in the market, and it's, what you're up against, the technologies that they have, it's very difficult to make, a quick buck, so to speak. It's also very risky in the sense that you could lose some money there as well. And also trying to time the market, you can make the excuse that you put off investing for, a long period of time until the perfect moment arises, and that might never come. So I think you miss out, like you said, on the opportunity to build long-term wealth. I mean, there's a reason why the super funds, you put money away towards your super fund every single month or whenever you get your paycheck, because you build that wealth over a longer period of time. And so I think if, despite Australian investors investing less regularly right now, I think hopefully we can return to a place where people do invest on a more regular basis in order to, follow that golden rule of investing regularly to build that long-term wealth.
Well, one thing I did note in the survey is the amount of money people think they need to have to invest. And I actually thought it was quite high, because you can invest small amounts and build it over time. Though I think the numbers, certainly for males over females, was relatively high.
Yeah, it was interesting to see the difference between males versus females in terms of what they thought was needed to get started in investing. Males thought you needed about $16,800 versus females almost half at $8,800. So quite a difference there, but agree, Sean, I think it was interesting that the number was so high. Even broadly speaking, investors this year still thought you needed $13,000 $200 or so to get started in investing. And to your point, you can get started for much, much less. Maybe it's a reflection from the Australian investor that maybe they feel priced out of certain things. Maybe they feel priced out of the property market. Maybe they feel priced out of investing. And I guess that's just not the case. To your point, they can get started for very little. The sooner you get started, the quicker you'll be able to build that long-term wealth, right? And the sooner that compound interest, that compounding effect will take place. And so, I think there is an opportunity to sort of bring that number down, hopefully, and get more people investing at a lower minimum.
Hopefully. David, thank you for talking to Fear and Greed.
Fantastic, Sean. Thanks so much for having me.
That was David Talbot, Senior Manager Investments at HSBC Australia. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.